Rebecca Patterson. Rebecca, happy Monday. Good to see you.
Good to see you, too.
I know your general view is that the market continues to be pinning its hopes on something resembling a Goldilocks soft landing, which I think in your view is relatively unlikely. I guess the question is, when does the market come around to that point of view, if they do?
Well, right now we're seeing some support for the market coming through corporations and still very large buybacks, and also from the retail investor as we continue to see the real economy slowing. And we're expecting to see a real economic recession in 2023. We think that there will be a growing risk that those retail investors pull back and eventually the corporate buybacks also slow. So that removes a level of support from the market. But I think the bigger deal and what's so different about this particular cycle is that the fall we've seen in equities so far is really just a function of the rising discount rate. We haven't seen cash flows affected yet. As the real economy slows and the Fed continues to tighten, both through rates and quantitative tightening, we think you are going to see that feed through to earnings. And as we see that earnings correction, so to speak, that's going to be the next leg lower in equities. So we think it's still ahead of us, and we don't expect to see a bottom until the Fed tightening cycle is behind us.
So we were just talking with Kramer a few moments ago about what we used to call a pre-announcement season in advance of earnings in a couple of weeks. Is it too early for that to be felt at the corporate level, where it's telegraphed through communications and earnings? Is that more of a back half story?
I think that's a great point. You know, at this point, I would expect it to be very sector and even company specific. The companies that are going to be more exposed to Europe, for example, are probably feeling more of the slowdown that's already coming through there. Companies exposed to interest rates and the housing sector might see it more there. So I think it's going to be hit and miss in the early days of this earnings season. But I do think it's pretty reasonable that we could see some cautious earnings guidance coming out of this season. And the question to me is, how much does that start moving earnings expectations?
Yeah, Rebecca, as to where you would be putting money to work right now, I see that you are bullish on overseas markets, a place I follow very closely. China in specific, the K-Web China Tech Index has rebounded significantly this month, on pace for its best month of the year. And I'm just curious if that's a market you're looking at.
Yeah, so we are looking for better equity returns out of China and Japan over the coming quarters. And I think that's partly because the valuations are so unaggressive, so to speak, versus the U.S., but also that policymakers just have a lot more room for maneuver. We are seeing continued monetary easing out of Japan and China, fiscal easing out of Japan and China in particular, I think, trying to hit that growth target this year, which seems unlikely, but they're going to try for it. And that means they have to get a lot more aggressive on stimulus. And I think we're hearing that in the policymaker comments. Kind of putting a pause on some of the tech regulations, et cetera, I think also opens up investors' comfort to look at that sector again.